In this lecture, I'd like to talk about the creation of wealth, how to create wealth, and in particular, the wealth-creating aspects of the capitalistic system of organization. Some of the main ideas today are that voluntary transactions are what create wealth, and they do this by moving assets from low to high-valued uses. Anything that impedes the movement of assets from lower to higher-valued uses either destroys wealth or prevents the formation of wealth. And three commonly identified factors or mechanisms that prevent the formation of wealth that we'll talk a little bit about include taxes, subsidies, and price controls. A price control prevents the formation or the movement of wealth from a lower to a higher valued use. Taxes, very similarly, will prevent some wealth-creating transactions from taking place. And subsidies will oftentimes actually move assets from higher down into lower valued uses. Economic analysis will help us to identify assets in low-valued uses. Now, the art of business can be thought of as moving assets in a profitable way from lower to higher valued uses. One way to think about a firm is as a series of transactions. These transactions have the goal of moving assets from lower to higher valued uses. And a well-designed organization is one that rewards employees who generate profitable transactions, i.e. who move assets from lower up to higher valued uses, and stop unprofitable transactions. One of the key ideas in economics is the concept that wealth is created when assets move from lower to higher valued uses. Now, when we talk about value, what we mean is both the willingness and the ability to pay, so the desire plus the income. Now, this might strike you as a little bit odd. Sometimes we think about a situation where perhaps I think of myself as valuing something, but I simply can't afford it and therefore can't buy it. From an economic standpoint, we're going to define value as both the desire or the willingness as well as the ability to pay. And one of the consequences of this definition of value is that the price mechanism or prices will then convey or communicate each individual's value of every economic item. And so prices become the mechanism by which every individual's value is communicated to other market participants. One of the chief virtues of a capitalist economy is its ability to create wealth. This is done through voluntary transactions between individuals or between firms, and these voluntary transactions ultimately all are moving assets from lower to higher valued uses and thereby creating wealth. Let's take a very simple example to illustrate this. Suppose that we have a house for sale and a buyer, a potential buyer, values this house at $130,000. You could think of that as their top dollar. They're willing to pay up to $130,000 because that's the level at which they value it, but no more. At the same time, the seller who's residing in the house values the house only at $120,000. You could think of this as, their bottom dollar. They'd be willing to sell the house for $120,000, but no lower. So we've got some wiggle room here. We can see $10,000 of wiggle room between the seller's bottom dollar and the buyer's top dollar. So the negotiation in a simple real estate transaction would involve some kind of back and forth, and the buyer and seller would agree to split what I'm going to call the surplus, the $10,000 of value that's created. Let's just suppose they come to a price or settle on a price of $128,000. This transaction is going to create surplus or economic value for both parties. Both the buyer and the seller benefit. The buyer is willing to pay up to $130,000, so they look at this transaction as if they have received for $128,000 an asset that they value at $130,000. On the other side of the transaction, the seller looks at this as receiving $128,000 for an asset that they really only value at $120,000. So it's a win-win in some sense. The surplus here is going to be split between the buyer and the seller, the surplus being the difference between the $120,000 and the $130,000. The buyer's value minus the price they pay, so $130,000 minus $128,000, gives us the buyer's surplus, $2,000. The seller's surplus equals the price minus the seller's bottom dollar, $128,000 minus $120,000. That gives us the seller's surplus of $8,000. We can see that both the buyer and the seller walk away from this transaction with a positive surplus, and therefore an economist would consider this to be a wealth-creating transaction. The total surplus here is the sum of each party's surplus, and as mentioned a moment ago, that total in this example is $10,000. Let's consider some examples of wealth-creating transactions. And in each of these, let's begin thinking like an economist and ask the question, what asset is being moved in each transaction from a lower to a higher valued use? Let's think about a factory owner. In what way would, say, a classical factory owner be creating wealth? Well, if we simplify the production process, the factory owner is in some sense buying labor from their workers, buying input goods that they're using to produce their product, and buying or borrowing capital from an investor. All of these are then being used to produce a finished product which is sold, and the labor, the capital, and the inputs are all being transformed from a lower to a higher valued use, assuming that the business is profitable. A real estate agent is an example of a financial intermediary, as would be an investment banker. In any situation involving an investment or a financial intermediary, the financial intermediary is facilitating the movement of assets from a lower to a higher valued use. With a real estate transaction, such as the one we just discussed, the real estate agent or broker might facilitate that transaction, finding a buyer and matching them to a seller or vice versa, and in so doing, help to consummate a wealth-creating transaction. In a similar manner, an investment banker might find a firm that needs capital, investors who have capital, and might facilitate the movement of that investment capital from a lower valued use in the hands of the investor to a higher valued use in the hands of the firm where it's invested, put into productive use, again creating, or at least facilitating, a wealth-creating transaction. A corporate raider. Great book in case you are looking for a read on corporate raiders. Barbarians at the Gate is a classic book that describes the process of a corporate raider, wherein they come in, purchase or buy up a company, and then oftentimes break that company up into its component parts and sell those off. The idea being that sometimes the sum of the parts is worth more than the whole. In that instance, the corporate raider is identifying assets that can be more productive when viewed or traded in isolation on financial markets, and by buying up the firm and breaking it up, unlocks some of that value. An insurance salesman, again, would be an example of a financial intermediary moving assets from a lower to a higher valued use and facilitating that transaction. A couple of examples that often come to mind or are often advanced as potentially creating wealth are mergers and government actions. Let's talk first about mergers. Does a merger create wealth? Mergers describe the movement of assets from, or a successful merger would move assets from a lower to a higher valued use. Again, remember, that's the basic idea in capitalism or behind the capitalist system. And in many capitalist economies, including that of the United States, corporations are some of the largest and financially or economically most valuable institutions. So it's certainly an important question to ask whether combining those institutions by way of a merger does or doesn't unlock or create value. Let's take an example of a merger that did create value. Back in 2006, Dell purchased a maker of high-end gaming equipment, Alienware. And the idea behind the merger was that Dell felt that they could improve upon certain aspects of Alienware's business model, particularly the production. However, Dell wisely, in retrospect, left the design, the marketing, the sales, and support of the Alienware products in Alienware's hands. What Dell took over was the manufacturing. Dell already had a sophisticated and advanced manufacturing operation, and they saw the process being used at Alienware and believed correctly that they could improve upon that and pull some efficiency gains out of the process by which Alienware's manufacturing was moved over to Dell. The manufacturing expertise at Dell did lead to substantially lower production costs, and as a result, value was created. Remember, to create value in the instance of a merger, assets need to be moved from a lower to higher valued use, and in this case, that means that assets must be valued more highly by the acquiring firm than they were by the selling firm. Does the government create wealth, or can the government create wealth? That's another very important economic question, both from a theoretical as well as just from a practical policy standpoint. So what is the government's role in wealth creation? The government has several roles, and most economists would say that those roles, at a minimum, involve the establishment of the rule of law, enforcement of private property rights, and the maintenance of certainly a monetary system and the institutions that are necessary within a society to facilitate and foster the creation of wealth. In fact, beginning with Adam Smith in 1776, he began asking the question, why are some countries so wealthy and other countries so poor? What are the determinants of the wealth of nations? Many of you have heard of his book, The Wealth of Nations. Since the time of Adam Smith up to present, one of the major determinants of differences in the wealth of nations can be boiled down to differences in property rights and differences in legal systems. In fact, modern-day historian and economist Hernando de Soto has an extraordinarily insightful book, The Mystery of Capital, in which he surveys worldwide differences in economic, legal, and judicial systems, and comes to this very basic conclusion that property rights and the enforcement of those property rights through an efficient judicial system is one of the primary determinants of differences in wealth across countries. So one role that the government certainly plays has to do with the enforcement of legal contracts and the establishment and support of an efficient judicial system. Sometimes government intervention can be motivated or at least suggested based on the argument that markets are failing. Sometimes markets do fail, and sometimes markets just produce results that people don't like. So a legitimate case for government intervention can certainly be made in instances where markets do not form or break down. There are certain human needs that are not met by markets, where markets simply will not form. And those could range from certain insurance markets to other markets that meet basic human needs, such as food and other subsistence levels of human needs. In those instances where markets don't form, there's certainly a case to be made for government intervention. There are other instances where markets may form, but just produce results that many people dislike or find uncomfortable. For example, the market for human trafficking is alive and well. It's a huge multi-billion-dollar market that has formed and exists despite the fact that market comes at a very high cost and imposes a very high cost on many of those involved. In that case, it's not so much the case that a market failed to form, it's the fact that markets are amoral. Markets cannot distinguish or differentiate between human needs and human wants, human virtues and human vices. And so in that case, many would still argue for government intervention, but it's not because a market failed to form, it's because a market formed and met the needs or wants of the market participants, at least on one side of the transaction, but it's not the answer, or it's not something that most people like, rightly so. And so in that case, a second reason or justification for government interaction or involvement or intervention is not that a market doesn't form, but that a market forms that violates basic standards of decency and morality. And so this is another example where we see that economics at a very basic level can't be totally separated from human values and human ethics. And so ethical frameworks and the value system of the economic decision maker are relevant and can't always be separated from economic policy decisions. Now, an economy is defined, or economists would define an economic system as efficient if all of the potential wealth-creating transactions have been consummated. In some sense, this is like the idea of a perfect vacuum. It's not really attainable in practice, but it's a useful benchmark that we can use when measuring economic systems against each other. If we get back to the one basic lesson of economics, or the basic idea that wealth creation occurs when assets are moved from lower to higher valued uses, and we apply this in the context of government policy, then it's important that we look not only at the immediate but the long-term effects of any policy. And that means that we trace the consequences of the decision of any particular policy, not only for the group or groups that it's intended to affect, but to all groups. Oftentimes there are both intended and unintended consequences of economic decisions. And to truly measure the efficiency of an economic decision, we need to be cognizant of all of those. Then, economic policies can be judged and evaluated based upon whether they move us toward or away from economic efficiency. The economist's solution to an inefficient outcome would be some kind of policy change that moves the economic activity towards more efficiency, not towards more inefficiency. So let's think about or discuss very briefly three items or three instances of policy intervention that have an impact on wealth. First, taxes. An economist would say that taxes destroy wealth because they deter certain wealth-creating transactions. The larger the tax, the more it will either destroy wealth or prevent the formation of wealth. Let's take a very simple example, similar to the real estate example that we talked about a little bit ago. Let's consider a house for sale, and the buyer is willing to pay $240,000 while the seller is willing to sell for $200,000. There's a $40,000 surplus that can be shared between buyer and seller if this transaction goes through. A simple example of a tax that would prevent this transaction is the real estate sales tax in a country like Italy. Italy imposes a 25% sales tax on the seller for all real estate transactions. Now, if you think about this, we know in this simple example, any deal between the buyer and the seller has to be between $240,000 and $200,000. Let's suppose that it's at $200,000. If the buyer is able to talk the seller down even to $200,000, a 25% sales tax on top of that means that the total cost to the buyer is $250,000, the $200,000 plus $50,000 in taxes. But $250,000 exceeds the $240,000 top dollar price that the buyer is willing to pay. In this case, what's going to happen? Nothing. The 25% sales tax will prevent the buyer and the seller from coming to terms because there's no price that the seller is willing to accept that is low enough that the buyer is willing to pay. And so this is an example where taxes would prevent the formation of wealth by preventing a wealth-creating transaction. Subsidies are another example of government intervention that oftentimes destroy wealth. Now, there are arguments to be made for subsidies, but subsidies will always have the following impact. They will always tend to move some assets from a higher to a lower valued use. If collectively people believe that for some reason those assets should be put in a lower valued use, perhaps it's some new technology that collectively people believe will down the road be a much more highly valued, there might be a legitimate case to be made. But nevertheless, subsidies move assets from higher to lower valued uses. Take, for example, flood insurance. The United States government subsidizes the purchase of flood insurance for individual homeowners who are in floodplains. What is the consequence of that? One of the consequences is that it encourages people to build in areas where they otherwise would not build houses if flood insurance were not available. Why would they otherwise not buy or build houses in those areas? Because the expected economic loss from a flood is sufficiently high that it would deter them from doing so. What would they do instead? Most likely they would build or buy houses in economically higher valued areas that were not susceptible or prone to the economic losses associated with a flood. Therefore, flood insurance, all else equal, will encourage more houses being built in flood-prone areas than otherwise would be. And from an economic standpoint, because of the economic loss associated with floods, those are lower valued areas relative to housing areas not in a floodplain. Last example, price controls. Price controls can destroy wealth. A very simple example, New York City for many years has implemented rent control or price ceilings. And what a price ceiling would do at a very simple level is destroy wealth-creating transactions in the instance where the price ceiling is below the seller's bottom dollar. If the maximum rental price is $1,500 per month and I own an apartment that I would be willing to rent, but only for $2,500 a month or more, you can see that that price ceiling would eliminate my participation in the market and lock me out of that market and lock out of the market a renter who might potentially be willing to rent my apartment for $2,500 a month or more simply because of that price control. So taxes, subsidies, and price controls are three examples of government policy that certainly have wealth implications and tend to move assets from higher to lower valued uses, the opposite direction from what we want if wealth creation is our goal. In all instances, we want to be asking, as an economist, which assets are we looking at and which assets are the ones ending up in lower valued uses. And that's going to help us as we go forward in thinking about economic problems, be able to identify and articulate what those assets are that are in low valued uses, and by doing so, we're then prepared to formulate strategies to move them into higher valued uses. Again, the one idea here is that wealth is created when assets are moved from lower to higher valued uses. Inefficiency then means that there are some unconsummated wealth creating transactions, meaning there are some assets employed somewhere in the economy that are not in their highest value use. And the art of business consists in identifying these assets and then devising profitable ways to move them from lower to higher valued uses. I want to thank you for listening to this lecture on wealth creation, capitalist system, and the art of business.